Welcome to the Techno Fundamental Report for November the 27th. Well, as we get towards the end of the year and we get into next year, we're going to have to deal with taxes and tax returns. I did want to mention something about that. You know, you have a benefit with the stock market. If you do have losses from the past, you can carry them forward indefinitely. And so you want to be aware of your loss carry forward. And one thing that we think is important, you know, it's great to get long-term capital gains, but it's just sometimes not a realistic situation. So what we like to refer to is something called a tax bank, where you keep your losses small, because when you're coming out of a bear market and you're going into a bull market, during that bear market phase, you're going to have small losses if you kept your losses small. So you build up a credit, a tax credit that you can carry forward. So as we get into the bull market, and hopefully it lasts for many years, and then we can use those losses to offset gains. One of the things I wanted to mention was that a lot of the companies we look at, the most successful companies, are involved in products and services that appeal to the masses. I mean, think of Walmart, think of McDonald's, think of Amazon. You know, if the masses can use the product and the service, it almost becomes an unpredictable situation, which is kind of what you want. The idea of excess diversification is madness. Wide diversification, which necessarily includes investment in mediocre businesses, only guarantees ordinary results. Diversification is for the know-nothing investor. You know, we do diversify, but we keep it within about 5 to 10 companies, because as Buffett points out, you got to know something about these companies. So if you have a portfolio, let's say of 30, 40, or 50 stocks, it's just very difficult to keep track of all that. So, you know, diversification is where you own a wide variety of investments with different characteristics to reduce volatility. But at the same time, if you're on top of it and you can keep your numbers under control, you're probably going to reduce risk that way. Now, we are in a bull market, so never look a gift horse in the mouth. Make hay while the sun shines, that kind of thing. This is a quote by Will Rogers. Don't gamble. Take all your savings and put some good stock. Buy some good stock and hold it till it goes up. Then sell it. If it don't go up, don't buy it. I think that's kind of interesting. Not very realistic. So how long do bull markets typically last? Well, historically speaking, you know, this can go on for years. And you know, if we look at the past here, you can see back here in 1987, the market went up for 148 months. I mean, bull market for 148 months. So, you know, get comfortable. Things are looking good. We are in a bull market. Now, also, if you look at first quarter results, and this is kind of what you refer to as the January effect, but going back to 1961 out to this year, if your first quarters are up 10% or more, the final 9 months of the year, the average gain, the gains are like 90%, and the average gain and the median gain is between 6 and 8%. So we are in a bull market, and I could just tell you, get comfortable. Now, there's a new indicator that I'm trying out. I'm not sure about it. It's something that I've learned about here recently. It's been around for a long time, but it's called the Ichimoku Cloud. Now, it's designed to help you with trend direction. It's designed to help you know where support and resistance in the price is. And then it also helps you with when you see breakthroughs through the cloud. This was developed in Japan in 1969. So let's look at one and just, like I say, this is a study and process. I'm not really sure on how I'm going to use this, but I have some general ideas, and we'll talk about that. Now, what you want here, now here's the rule. For bullish odds to increase, and that's what this is. This is just a statistical graph trying to identify how strong the trend is, because we are trend followers, and when we see a strong trend, that's what we're looking for. So the way this works is you have basically 3 calculations, and then you have the price, and then you have a 4th calculation which results in this cloud. Now, the way it works is you want green above price, which it is. You want blue above red, which it is, and you want the cloud to be green. And this tells you that using the Ichimoku cloud, that this is a very strong uptrend. So let's go back in history and just kind of see how I think this should be used. So this is the bear market of 2022. Now, if y'all remember, in 22, the Fed raised interest rates from basically 0 to 5%, shocked the system. We went into a bear market. The NASDAQ was down 40%. So you can see here, the cloud started to turn red. And that would have been a definite warning. And you can see the other calculations were all breaking down as well. Now, where this could really come in handy is if you see here, the bear market basically didn't end until around October of 23. Then the cloud went from red to green, and all these particular indicators went positive. So this thing really did kind of call a low here. Now, the major low was here, but then as trend followers, we have to wait for the trend to develop because we don't know if this is going to continue down or not. But this is interesting. So we're going to keep an eye on the Ichimoku cloud. Now, interest rates, this is the power index, one of our indicators that we use. For the last 125 trading days, interest rates have basically been coming down. And you can kind of see here with the 5-year Treasury, it's rolling over somewhat. So interest rates are not getting out of hand here. The primary trend is up. Here's our 200-day moving average on the S&P, and here's the 200-day moving average on the NASDAQ. Both indexes are in an uptrend, nice uptrend. Value line geometric. Now, I keep showing this particular index because I really feel that this is the most important index to follow because it's so real. It's the real world. We're talking 1,700 stocks, equally weighted, not market cap weighted, so you really get a truer picture. So you can see here was the bear market of 22. We consolidated for over 2 years. Now we're breaking out, and we're breaking out in a meaningful way. I mean, actually hitting a new high since the breakout. So the value line geometric is looking good. Now the aggression index is on a buy signal. It's basically saying you should be aggressive here. This is the time. Like I say, make hay while the sun shines because bull markets come and go, but right now things look good. So be aggressive here. Small cap index, wanted to mention the small caps. They are breaking out. Now you have to realize why this is important because the small caps tend to be a risk-on group of stocks. I mean, these are companies that don't possibly make a lot of money. They borrow money, so forth. These are smaller companies, but you can see here how dramatic that breakout is. So, like I say, things are looking good. If you have any questions, please let me know. Thank you very much.